Hey guys, Bert Salazar here. Thank you so much for joining us for another webcast. Over the last few weeks, we've been talking quite a bit about life insurance audit. There's a video that I put out there regarding the process that we use at Cambridge in order to assist all of our clients when it comes to life insurance audit. And we also did a webcast last week regarding the importance of having a life insurance audit program as part of your financial planning. Now, obviously, over the last 28 years more so, we have conducted a tremendous amount of life insurance audits. Just over the last 10 years, we've done approximately 1,700 audits, and we have found that in 70% of all the cases, the majority of those contracts were failing and lapsing, but the clients were not aware of it. So by doing a life insurance audit and/or review, all of you are going to have the ability to be in a much better position when it comes to understanding what your insurance program can and what your insurance program cannot do. Now today I'm going to walk you through actual cases we have done over the last few weeks. I think we've done them over the last 6 weeks. As a matter of fact, there are 5 of them I'm going to walk you through fairly quickly, just to give you an update of what the capabilities are and what you should be looking for when it comes to doing an insurance audit. Now, whenever we engage a client on an insurance audit program, whether the client comes through us, through recommendations from existing clients, which we do have a tendency to get quite a few of those, but also through our online marketing program. Actually, these 5 clients came through our online marketing program. We do a lot of work for them. So we gather all the information that they need to provide to us. We sent letters to their insurance companies just to make certain that they send us in-force illustrations telling us exactly what their contracts are doing for them and their families. And then we start to break down those contracts in all different areas. For instance, number one, how is a death benefit ascertained? Many clients that we have dealt with and many people that we have, talked to over the last 20 years or so, basically have stated that they just picked a number from the sky and brought it down to the insurance contract. That's not how insurance planning is done. We try to use economic models. We try to use human life value calculations, which is the right amount and that gives you the right amount that you should be having in your insurance program, depending on what it is that you're trying to do. Because of my law enforcement background for many years, prior to entering financial services 28 years ago, I deal with a lot of public employees. So when it comes to their retirement, they have to make a critical decision at some point in time in the future. Are they going to take the maximum distribution out of their pension without providing protection for their surviving spouse? Or are they going to take a reduced pension benefit in order to provide that benefit? Most of the public employees that I deal with choose to obtain the maximum amount of money out of their pension, because that way they're not giving up on inflation and so forth, but they provide survivor benefit protections by purchasing life insurance, guaranteed life insurance contracts outside of their pension system. Now, this applies not only to clients that have pension systems that they deal with, whether there's a public pension system or a private pension system, but it should apply to each and every one of us, because at the end of the day, we need to be able to provide benefits to our families and be able to protect our families in case of our demise from a business standpoint. So again, today I'm going to cover 5 quick cases for you, so you get a feel of what the capabilities are out there in the marketplace. Before I get going, please bear in mind that Cambridge is an independent financial services firm. So we are not married to any one client or one insurance company. We are married to our clients. So in other words, if you come to us with an issue and we need to do some research on your behalf, we're going to go out into the insurance industry marketplace and we're going to identify the best products, the best services, and the best company that can provide those services to you and your family at the end of the day. So that's something that we do, and we're very proud of the fact that we're independent, and we're going to remain so for many, many years to come. So without any further ado, let me walk you into these contracts. Now, The one major thing that we try to do whenever we review these contracts for our clients is to try to obtain two major objectives. One, can we maintain the current coverage that the client has as far as death benefit is concerned? Can we maintain that coverage and still be able to reduce the annual premium and also be able to extend the guaranteed period? Because at the end of the day, when we do insurance audit, we don't worry that much on what the current period or forecasted period is for the validity of that contract. We only pay attention to the guaranteed side, which is the one that really matters. Anything other than the guaranteed, you're pretty much making a bet. Sometimes you're going to win, sometimes you're going to lose. So in this first contract, this is a client that came to us approximately 6 weeks ago. The client has a life insurance contract. It's a permanent life insurance policy for a death benefit of $1,081,000, and the client is paying $10,958 per year. Now, on a guaranteed basis, this contract is going to go away or is going to lapse at the age of 62. On a current basis, it may go as far as age 88. So at the end of the day, it's going to lapse somewhere between age 62 and age 88 from a business perspective. Now, if we look at the first objective, which is let's see if we can reduce the premium, maintain the current coverage that the client has, which is $1,081,000, and see if we can guarantee that coverage for a longer term. That's what we try to do in the first objective. In this situation, we were able to go out to major carriers throughout the marketplace, and we identified 4 carriers that could exactly do that. The top carrier out of the 4 was able to increase the death benefit a little bit from $1,081,000 to $1.1 million, but it reduced the premium significantly from $10,958 to $8,846. That's a tremendous reduction in premium. But most important, instead of the policy lapsing and or dying at the age of 62 on a guaranteed basis, and in a best case scenario at the age of 88, this policy is guaranteed for the entire life of the insured. So therefore, we were able to increase the death benefit just a little bit to $1.1 million. We were able to significantly reduce the premium on behalf of the client from $10,958 to $8,846. And most important, we were able to guarantee that coverage for lifetime. That's an enormous difference compared to what the client had. And in this situation, the client was not aware of what the capabilities could have been for himself based on his insurance contract in the marketplace. The second option, or the second objective that we try to accomplish, is not only reducing the premium, maintaining the death benefit, and increasing the guaranteed period, but the other objective is well, what if we keep the premium at the level that the client is paying today, which in this case is $10,958? Can we now buy more insurance for that same premium? And most important, can we extend the death benefit guarantees for a longer time? And in this situation, the $10,958, which is currently supporting $1,081,000 of death benefit, now has the ability to support a death benefit of $1,333,000. So we've gone from $1,081,000 to $1,333,000, and that's on a guaranteed basis for the same amount of premium. And most important, now that death benefit is guaranteed lifetime. So that's an enormous difference on behalf of the client. Now, in this situation, the client had 4 options that he was able to do. Number one, make no current changes to their existing contract, continue to pay the $10,958 a year, and hope for the best. Hopefully, the policy is not going to die before the client does. The second thing that the client could have done they could have kept the same contract, but instead of paying $10,958, they could now increase that premium to $12,556, and then that would give the client the ability to extend that guaranteed period to age 95 on a current basis as opposed to age 88, and on a guaranteed basis from age 62 to age 80. Okay, so it does a little bit better for the client, but at the end of the day, the client is paying more premium toward that. Option 3, the client in this situation can acquire a new policy. The new policy will have a guaranteed premium of $8,846, which is a reduction of $2,112 per year compared to what the client was paying today. And most important, it would maintain the policy in place to maturity and also lifetime for the remainder of the client's life. The fourth option was to maintain the same premium that the client was paying, which is the $10,958, and now the client was able to purchase an additional $252,000 of additional coverage for the same premium and be able to guarantee it for lifetime. So obviously we're not going to go into details as to which option the client chose, but the client did make a decision to choose of either option 3 or option 4. Now the second case that I have for you, it's a similar case. The death benefit is lower. This is a client that has currently a death benefit of $791,000. $791,000. They're currently paying $12,000 of premium every single year, and on a guaranteed basis, this contract was going to lapse at age 72, and on a current basis, it would be at age 86. Again, at Cambridge, we only look at the guaranteed because the current, you're just making an assumption and you're just making a bet. And when it comes to insurance and guarantees, you cannot afford to make bets. So the key question is, well, can we reduce the current premium and extend the coverage? So we were able to find a major carrier. Actually, we found 3 of them that was able to provide the $791,000 of death benefit that the client has today, and we were able to reduce that premium from $12,000 to $7,287, and we were able to provide that benefit on a guaranteed basis lifetime. So that's an enormous difference in this scenario. And then the second objective that we try to accomplish in this contract for the client in this particular case was, can we maintain the premium and increase the coverage? Again, in this situation, by maintaining the same premium that the client is paying today, which is $12,000 a year, we were able to buy additional coverage. So we went from $791,000 a year to $1,041,000 a year, and now the coverage ran all the way to age 105 compared to age 72 on a guaranteed basis and or age 86 on a current basis. The age 105 now is a guaranteed coverage to that period. So again, in this second scenario, the client is a much better position than they were before they did an insurance audit on their current contract. The third one that we did, this is a female client who owned 4 whole life policies, and all 4 policies had a combined death benefit value of $265,000. Now the client did have $79,000 in cash value and was paying premiums of $2,500 a year every single year on 2 of the 4 policies. So once we did our due diligence, our recommendation to the client was the following. Number 1, the 4 policies were reduced to 1 policy. Number 2, out of the $79,000 of cash value, we took $55,000 of that cash value and we used it as a single premium on a new policy with a death benefit of $266,000. So that meant that we took that premium, but paid one premium, the $55,000 period. We purchased $266,000 of guaranteed death benefit, and that policy would go all the way to the age of 120 years of age. So it is guaranteed for life. No additional premium was required, which resulted in savings of $37,500 over a 15-year period, because the client was paying $2,500 a year and had to pay that amount for another 15 years. So we were able to equate the benefits, we were able to reduce the premium, we were able to make one lump sum payment premium, the remaining cash value, the 79 minus a 55, the remaining 24,000, the client was able to take out on a tax-preferred basis and is now able to put it into savings, investments, spend it, whatever the client wanted to do. So that worked out really, really well for this client. The fourth client is a 57-year-old male who owned 2 whole life policies and 1 term policy, and all of them combined had a death benefit of $385,000. The client did have a loan on one of the policies for $36,000. So here's what we did in this situation. Now the client is also paying $9,800 a year on these contracts. So we were able to take the 3 contracts and combine it into 1 contract. The new policy was a 15-year term because the client had no need for any additional insurance past the 15th year. And we were able to purchase $400,000 of guaranteed death benefit. The premium savings, because now the client is not paying permanent premium, the premium savings over 15 years was a total of $105,000. Now the client can take that additional premium on an annual basis and put it toward some kind of a guaranteed retirement plan. And obviously you have the increase in not only that contribution on an annual basis, but also the internal rate of return on that program as well. And the policy with the outstanding balance was canceled, and it canceled itself out, and there were no tax liabilities on behalf of the client. And the last case I want to cover with you today is a 75-year-old, this I did about 3 weeks ago, who owned 3 fixed universal life policies with a combined total death benefit of $827,000. Now the total cash value in all these policies was $225,000. All policies, after we did our due diligence, were scheduled to lapse at age 88. Now he was very concerned in this particular situation because he's 75. His mother died at the age of 102. His father is 99 years of age and still alive. So he has very good genes and mortality or longevity on his side of the ledger. So he was very concerned that these policies were going to lapse and the policies were going to die before he did. So he was not going to be able to collect any type of death benefit proceeds. And all that premium that he paid over all those years were just going to go away. Not only the premium, but the opportunity cost on the premium, because if he had put that money somewhere else and that money would have grown at a given rate of return, then not only is the client losing the premium, but what he could have done with that premium. So that was a pretty bad situation for this client. Here's what we were able to do. Number one, we combined all the policies and reduced it to 1 policy. All cash values, the $225,000, we moved it over to the new contract under a 1035 rule, so there were no taxes on the client. It was just a direct transfer from a business perspective. The new policy was guaranteed to age 120. That's awesome. And this is a client who's 75 years of age today. And the new death benefit went from $827,000 to $945,000. And most important, no additional premium was required in this case. So at the end of the day, as you can see, I have just walked you through 5 cases that we have done in the last 6 weeks, perhaps 7 weeks. And in all of those cases, we have had the ability to put the client in a much better position than they would have been otherwise. You know, many of us, when we purchase life insurance contracts or any type of insurance contract, the only time we pull it out of the drawer is when something wrong happens. But it is critically important that you pay attention to your life insurance contract, that you contact your insurance professional if you have one. Otherwise, feel free to reach out to us, because we are not married to anyone. We're married to you, the client. We will do our due diligence. We will put our guarantees behind it, and we will find you the right product for the right reasons, for the right services you are looking for, in order to make certain that your life insurance contract and the protection of your business and your family will be readily available at the time that you most need it. Now, if you happen to own a business, we do this all the time for business owners. You know, whether there are buy-sell agreements, whether there are key man insurance in place, whether there are executive benefits that are being provided through the use of life insurance, which is one of the best ways to provide executive benefits, or under Section 162 of the IRS Code, which provides executive bonuses to certain key employees in a corporation. So with that being said, I want to thank you all for being here. We wanted to be short, but by the same token, we wanted to be brilliant. Hopefully, you have gained quite a bit of information from this short webcast. Feel free to reach out if you have any questions, and we'll talk to you soon.